So next capital budgeting technique we have is accounting rate of return, ARR. This is a non-DCF criteria. That means it does not take into consideration time value of money, and this is relying on accounting profits. So again, cannot be the sole criteria we are looking at. Ideally, it should not be, because it is not considering time value of money and it is not considering the incremental relevant cash flows. Rather, it is relying on accounting profit, accounting entry of profit, which we do in the income statement. So what is the PAT we are able to generate from the project? Based on that, we are going to evaluate the project using the ARR technique. Accounting rate of return is the average rate of return for different years for the whole life of the project. So that means if the project is of 5 years, what is the accounting profit it has generated for 5 years, and what was the initial investment? Based on that, we will calculate the accounting rate of return and compare it with our pre-specified return. It is the ratio between the net profit after tax and the amount of initial investment in the project. Acceptance rule is ARR should be greater than pre-specified rate of return. ARR on average investment is equal to average profit after tax upon average investment into 100, and ARR on initial investment is average profit after tax upon initial investment into 100. Accounting rate of return is a simple method and easy to understand. It uses accounting information as revealed by the financial statements to measure the profitability of an investment. However, it ignores the time value of money and hence not suitable for scientific decision making. Let's look at an example. Initial investment in the project is rupees 50 lakhs with life of 5 years. The PAT for the project for next 5 years is 7,50,000, 8,20,000, 7,90,000, 8,90,000, 6,50,000. So what we'll do the average PAT. We'll calculate the average of these values. The PAT we got for 5 years, the average of this upon 50 lakh will give us the accounting rate of return, which is coming out to be 15.6%. So now we will have a pre-specified return that I want at least 14% ARR from the project. So if our pre-specified return was 14%, we will say this project is actually generating more than 14%. So we will go ahead with the project. If the pre-specified return we wanted was 20%, we will not go ahead with this project. Simplicity, it is simple to understand and use. It does not involve complicated computations. This can be readily calculated from the accounting data. No adjustments are required. This incorporates the entire stream of income in calculating the project's profitability.